because if you look at just the basic chart itself, this thing, I mean, gold has been an absolute tractor in first gear the entire way up. So first off, yeah, were we due a correction? Yeah, we're due a correction. We no longer were overbought. It looked like we were bottoming, and now it looks like they're trying to delay the bottom. But the bottom's going to happen nonetheless. And I think by year end, you'll see new highs on gold. And I'd be pretty surprised if you don't see silver at least sniff 35, if not go through it.
BillHolter, a financial analyst specializing in precious metals and global economics, reported significant market movements today. Both metals dropped sharply at the market open. Gold fell by around $70 to $75 and then dropped another $20. At the same time, silver was initially down by about $1 and later by an additional 10 to 20 cents, Holter noted. The $100 gold decline stems from increased risk sentiment following rumors of an imminent Israel-Lebanon ceasefire expected within 36 hours. Technical indicators suggest a short-term bearish trend. Before market analysis, Holter had been monitoring the charts for gold, silver, and the HUI index, mainly focusing on the MACD indicator, which was approaching an upside crossover for both precious metals. This technical observation combines with the current market situation, where silver trades at $32.28 per troy ounce, down 1.12% from $32.64, maintaining a substantial 35.64% year-to-date gain. Looking forward, Holter remains optimistic. While both metals are undergoing a correction, I expect gold to reach new highs by the end of the year, and am confident that silver could surpass $35, he stated. Mining.com shares this outlook, suggesting silver could reach $35 or higher, representing a potential 50% increase. Capital Economics reinforces this bullish sentiment through 2025, expecting silver to trail gold. Historical data supports silver's potential during accommodative monetary periods, evidenced by its 43% surge versus gold's 20.8% gain in 2020. The technical analysis approach combines MACD indicators with Fibonacci retracement levels, mainly focusing on the 50% retracement level. This fusion provides traders with a sophisticated method for identifying potential entry and exit points in MCX gold and silver contracts, offering a balanced perspective by combining trend momentum analysis with crucial price support and resistance levels. Before watching this video, remember to subscribe to the channel and hit the bell icon so you never miss an update. Also, remember to share it with anyone who might benefit from the content.
I mean, silver, gold went straight down off the open. They've not been too weak after that. I think gold was off maybe 70, 75 bucks. It's down another $20, and silver was like down a buck, so it's down another 10, 20 cents. But I think for sure you're seeing some covering here. And I mentioned to you before the call, just to pull that chart up on gold. If you look at gold, if you look at silver, if you look at the HUI index, you look at the bottom right-hand corner, if you could scroll down a little bit so people can see it. There you go, right there where your cursor is. It looks the same or very close for silver. The HUI actually had started to cross over on Thursday and Friday to the upside. Once the MACD crosses either upward or downward, then you get momentum players coming in. So the thought process in my mind over the weekend was, okay, let's see what happens on Monday, because even if it's a flat day, these MACDs are going to cross over to the upside, and you'll start to get momentum buyers. Well, they can read charts just as well as I can or you can or any of us can. They saw that happening, and voila, $1 plus on silver, almost $100 on gold. And that's not going to negate the crossovers, but it will delay them, maybe delay them 3, 4, 5 days, maybe delay them, if they've got a little bit more powder to get gold down another $50 or $100, they could delay it for a couple weeks. But that's all they're doing is delaying it, because if you look at just the basic chart itself, this thing, I mean, gold has been an absolute tractor in first gear the entire way up. So first off, yeah, were we due a correction? Yeah, we're due a correction. We no longer were overbought. It looked like we were bottoming, and now it looks like they're trying to delay the bottom. but the bottom's going to happen nonetheless. And I think by year end, you'll see new highs on gold. And I'd be pretty surprised if you don't see silver at least sniff 35, if not go through it. I mean, you're looking at those are COMEX positions, and we're very, very close to COMEX and LBMA becoming irrelevant because gold and silver, I mean, they're global assets, and you have global players buying the crap out of both gold and silver. Not so much silver, from a central bank standpoint, but what was it, 2 or 3 weeks ago? Russia stepped up and they said, well, yeah, we're going to start buying other commodities. And I think silver was the first one that they named. So it's not going to take a lot of money in silver to really upset that market. And you're talking about, that whole thing with the COT, commitment of traders. Those are paper positions. And when this game ends, paper is going to be meaningless. And I've said this for 10 years, that there is a scenario where you could see the paper gold price get absolutely slaughtered and go to $10 an ounce, offered, no one willing to buy. And then in the physical markets, you could see gold at $10,000 an ounce, but you can't buy any because there's none available. And that's the dichotomy between paper and real metal, because these buyers globally, they don't buy COMEX contracts. They don't buy LBMA contracts. They buy ounces and they say, deliver me my stuff.
Yep.
So we're getting much, much closer to that, Chris.
BillHolter presents a compelling analysis of gold's historical value trajectory, pointing to its price of $270 per ounce in 2000 as a baseline for understanding wealth preservation. This reference point illuminates gold's appreciation against fiat currency depreciation. Data shows that the US dollar has lost 23% of its purchasing power over the past decade. During this period, major asset classes have shown divergent performance, with stocks gaining 256% while gold rose 25%. Historical data confirms Holter's observation, noting that gold's average closing price in 2000 was $279.29. However, this figure is a crucial benchmark for understanding gold's long-term appreciation against fiat currency devaluation. Holter's analysis extends to the relationship between gold and national debt, mainly focusing on the U.S. Treasury's revaluation mechanism at the Federal Reserve. This system allows for higher gold reserves to be revalued, potentially creating additional dollars for the Treasury. Such a mechanism suggests a pathway for addressing national debt through strategically evaluating gold holdings and effectively using gold's inherent value to counterbalance fiscal obligations. Let's get back to the interview.
I was going to bring Judy Shelton up on my own, but I'm glad you brought it up. She just did an interview last week, I believe, with David Morgan, and talked about revaluing the gold. And what is the number? $700, $800 billion worth of gold. The bottom line is, and I'm not talking about any specific person, I should just say the whole thing is full of shit, because that's assuming that we have 8,300 tons. Do you assume that we have 8,300 tons? And I would just say, if you know for a fact that they're blowing smoke up your ass about CPI, about unemployment, about absolutely everything, if you've been lied to about everything, why would the amount of gold that the U.S. holds, why would that be the only thing that they're telling the truth about? That's the first thing. I mean, we don't have the gold to do it. So, assuming that we do have the gold, which I assume we absolutely do not, but assuming we do have the gold, so what? You're not even talking about $1 trillion worth of gold. You're talking about a $200 trillion debt problem in the United States. Are they going to actually revalue? Are they going to revalue gold up 200 times? Are they going to turn it into a half a million dollars an ounce? Is that what they're going to revalue? Because in order to cover the outstanding debt, that's the type of revaluation you'd have to have. And that's assuming that we have all the gold that we say we have. So if we only have half of the gold we say we have, now you're talking $1 million. We have a quarter of it, it's $2 million. Just do the math off of it. They're all full of shit. They lied to us about everything. The system's a Ponzi scheme. The whole thing's coming down. And yes, gold could save it. You would have to revalue the gold that we actually do have to numbers that are, to this point unthinkable, but they're gonna become reality. Paul Volcker was telling the truth right there. 2% is still skimming. I mean, why does your money have to become worth less each year? Why does there have to be inflation? The simple answer is because in a Ponzi scheme, you have to pay past investors. The only way to pay past investors is to have new investors create new debt to pay off past investors. I mean, under a gold standard, you don't have inflation. You have sound money. If you work for the week or you work for the month or whatever, you square up your books and you have a profit and it's in gold coin. Well, that gold coin is still going to be it's still going to be gold coin in a year or 5 years or 10 years or 20 years. It's still going to have value. It's not going to be debased. I mean, think about it. If you buried a perfect example, if in the year 2000 you buried $270 and you buried 1 ounce of gold, where would you be today? One versus the other. One's worth $2,600, $2,700. The other's still $2,700 or $270, which doesn't buy what $270 bought back there.
The shift in gold and silver markets reflects broader economic trends, with gold's appreciation over the years contrasting against the devaluation of fiat currencies. As the US dollar loses purchasing power, precious metals like gold and silver remain valuable assets, appreciating steadily. Gold revaluation offers a potential solution to the U.S. debt crisis, where adjusting gold's value could generate the necessary dollars to address the deficit. Ultimately, the market dynamics of gold and silver continue to serve as a hedge against inflation and currency devaluation. Do you believe gold and silver will continue their upward trajectory, or will we likely see a correction soon? Share your thoughts in the comments below. If you found this video informative, don't forget to like, share, and subscribe for more updates. Thanks for watching.